Good morning. At the end of every chapter, at least for the first several chapters, there's a thing called a serial problem. And the serial problem's a nice problem because it gives you every possibility or everything that they've talked about in the chapter. Now, I'm going to go to chapter two serial problem instead of starting with chapter one because it's going to be the same kind of a thing, except it's just easier to take both of these months combined. So let's just take a look at it here. On October the 1st, Santana Ray launched a computer services company called Business Solutions, which provides consulting services, computer systems installations, and custom program development. Ray adopts the calendar year for reporting purposes, means he ends on December the 31st and expects to prepare the company's first set of financial statements on December the 31st, 2019. Company's initial chart of accounts follows. And so I'm going to bring your attention to a couple of things here. If you notice, these things are numbered. If they start with a one, they are assets. So all of these are assets. Now, there are different classifications of assets, and I'll talk about that when I get over to the trial balance. But so, for instance, these are current assets. These are long-term assets. The office equipment, computer equipment are long-term assets. Here's your liability, and you only have one at this time, but notice it starts with a two. All liabilities start with two, so it might be 20,516 in big companies, but they always start with a two. The capital accounts always start with a three. The revenue accounts, and there could be multiple of those, they start with fours, and then five, six, sevens, eights, and sometimes nines are all expense accounts, depending upon how detailed they want to get to break them down. Here they just gave us everything as a six account, which is fine. Usually when you get into the 500 accounts and 700 and 800 accounts, they're breaking down general administrative expenses, they're breaking down selling expenses, and usually manufacturing expenses in the 500 level expense side. Okay, so the first thing we want to do though is we want to read the requirements because sometimes these accounting problems look incredibly long, and this one is quite long actually. But they look incredibly long, like a lot of work, and people just say wow and see all of this stuff and think they can't do it just simply because it's so big. But what you have to do is you have to do it like you'd eat an elephant, one bite at a time. And so here, prepare journal entries to record each of the following transactions for Business Solutions. And so they give us all these transactions. And then the second one is open ledger accounts and post the journal entries from part one to them. And the third is to prepare a trial balance as of the end of November. And they're good enough in this case to give us two check figures. The cash November 30th balance is 38,264, and the trial balance total is 98,659. Okay, so what I did in order to save time and make this thing a little bit easier to consume, I went ahead and did the problem. And I'm just going to walk you through some of the things that I did. Now, what I want you to know is that each time you make an entry over here, you would have to make an entry over here on your ledger account. So if I come back over here for a second, you see that I have cash 45,000, computer equipment 20, and office equipment 8,000. So if I come back over here to what is my makeshift ledger, I've got cash of 45,000, I've got office equipment of 8, and I've got computer equipment of 20. And then the other side of that then is the capital. That's your opening entry, and there's your capital of 73,000. So if I come back over here, you see that that is the fourth component here. Now notice these are not equal in terms of the number. There are three of these and only one of these. That doesn't matter. It can be 20 of those and only one of the other, as long as when you add up all of the dollars, they are equal. But they must always be equal after every entry has been accomplished. And so as we walk down through here, the next thing they did was they prepaid the rent. And all of this, of course, if you wanted to follow along with the problem itself, if you come up here, you see that they paid $3,300 for 4 months rent. And so all I'm doing is I'm just recording then the rent. And so here we have prepaid rent of 3,300, and that means it's paid in advance. It's an asset. It has a 100 level account. And so all I'm doing is I'm taking one asset, prepaid rent, and I'm swapping it for another cash, or actually it's the other way around. I'm swapping my cash for some prepaid rent. Okay, so the next thing is, and of course I'm going to go to the ledger, and if I find prepaid rent, there you see where I posted it on the left-hand side over here because it's on the left-hand side over here. Debit means left, credit means right. That's all it means, okay? And so the other side of that was cash, and there's the cash. So I had to kind of truncate all this stuff. So, and I'll point it out to you as we go, but I'm not going to go to every single one because we're going to do every single one exactly the same way that we did this first one. The next thing that happened is we went down and we bought some computer supplies on credit. And so computer supplies is an asset. And so we increased an asset by $1,420. That is an entry to the left-hand side. Because assets go up on the left, they go down on the right. Accounts payable is a liability. It goes up on the right and down on the left. I want to point to this little entry right here. This is the basic accounting equation. Assets is equal to liabilities plus equity. If you notice, the assets are on the left-hand side of that equal sign. And therefore, when they go up, they're going up on the left. On the right-hand side, you see liabilities plus equity. When liabilities are going up, they go up on the right. And when equity goes up, it goes up on the right as well. Now we're going to see some entries going into the left side of equity. That'll be on your expenses and your withdrawals. Now they're going to go up on the left-hand side, but they make equity in general come down. Okay, so those are important points. Now we went down and we bought some prepaid insurance. We prepaid, I think, a year's insurance for $2,220, and we paid cash to do that. Again, all I'm doing is I'm shifting assets. I'm taking an asset, prepaid insurance, and I'm giving an asset cash to get it. So other things equal, nothing really has happened here. So if you think about the equation up here, I have one asset going up by 2,200 and another asset coming down by 2,200. So the impact on the accounting equation here is zero. Okay, there's no impact at all. The next thing that we did was we sold some services, and that's what we're in the business to do. This is our revenue stream. So we're in a computer services business, so we do things like install servers and maybe provide some programming and that sort of thing. And for that, we receive either money up front or we receive a promise to be paid later. And that's what happened here. We didn't get the money up front. We got accounts receivable from this company, so they are going to pay us later. But I'm going to go ahead and recognize the revenue now because I've performed the service. So if we come back over here to the ledger, I want you to see this one. Here's the 4,800 that goes into accounts receivable. And down here is the 4,800 that goes into computer services revenue. Now, when they pay it, watch what happens here. This 4,800 is now on the right side of accounts receivable, which means if I just look at these two entries, I got the left side and the right side in the same amount, so it's zero at that point. And cash took its place. And that's what we always want to do when we sell something on time or on credit. We want to keep it on credit as the least amount of time possible and then convert it to cash. Okay? We'll get to that. You'll see the payment here in a minute. The next thing we did was we decided we were going to pay off the accounts payable. Remember, we had accounts payable that we incurred right up here. When we went down to the store and we got some computer supplies. The guy said, "How do you want to pay for it?" And we said, "Well, put it on our bill. Bill me for it." And so we create an account payable, means that we owe this money down the road. And here what we're doing is, notice it's on the right-hand side. So liabilities all go up on the right, they come down on the left. So here it's coming down because we're paying it off. Okay. And so if I pop back over here to the ledger, you'll see here's where we incurred the liability. Here's where we paid the liability. and the balance is 0. Okay. Accounts receivable, computer services revenue. So what we did is we sold some more services, and you'll see these kind of things just pop up over and over and over and over again. We'd like to see it pop up every day because that would mean that we're selling stuff. We're selling our services. In this case, we sold $1,400 worth of services. They did not pay us, not yet. They didn't pay us, so we have an accounts receivable, and we have an entry to the computer services revenue. All right. So the next thing that happened, this is where they paid the first company up here. I can find them again, right here. Notice that we did some services for them over here, and they didn't pay us. They gave us a promise to pay later. And now look what's happened. Here they paid us. And so I have to eliminate the accounts receivable because they don't owe us anymore. So if you think about it, 4,800 on the left and 4,800 on the right means 0 because we add likes and subtract unlikes. A debit and a debit are likes. A credit and a credit are likes. A debit and a credit are unlikes. Okay? All right, the next thing, and you can walk through these at your own pace. All you have to do is just slow down the recording and listen to it again or whatever you need to do. But I want to go ahead and get it out there because it's already up to 11 minutes. And the longer these things are, the more space they take up, and the longer they are to load up because it takes a long time for them to load up. All right, so what happened was we had something wrong with the computer, and so we had to get it repaired. And so we spent $805 cash. So cash is going down. Assets go up on the left, they go down on the right, and this is going down on the right-hand side here. And expenses go up on the left and down on the right. Now, expenses, what they do is they're part of equity. And so when you're incurring an expense, your equity is falling because remember from the basic accounting equation, equity goes up on the right. So this expense, all expenses, go up on the left. So they're reducing your equity. And the next one here is nothing, just exactly the same. The only difference is now we're doing an advertising expense instead of repairs expense. So it's the same kind of a concept. And so here we paid $1,728 for advertising, and we paid it in cash. So our cash goes down, our expenses go up. And if we pop over here to the ledger, I'll show you how that works. There's your $1,728 over on the left-hand side. So advertising expenses going up, and over here, repairs to the computer, that's where that went up. And all I did here is every time I made one of these entries, I just went over to this other side and I posted it. If it was a left-hand entry over here, it's a left-hand entry over there. If it's a right-hand entry over here, it's a right-hand entry over there, kind of like that. Okay, the next thing that happened is remember up here when we sold $1,400 worth of computer services revenue? They paid us. They paid us down here. So I have a debit to cash, the 1,400, my cash is going up, and I have a credit to the asset accounts receivable. Accounts receivable is going down. And that means that the people who owed us before don't owe us now, this 1,400 anyway. They paid 1,400 of it. Okay, the next thing that happened, this is another entry, and you'll see these kind of things, as I said, they pop up over and over and over again because this is what you're in business to do. This is why you entered the business to begin with, is to fill a niche. And in this case, they think that they can do computer services revenue better than most other people. So they started this firm. And now what they're doing is they're selling their services, and they're either getting paid for it immediately or they're getting the promise to be paid later. In this case, they're being promised to be paid later, $5,208. And again, if I pop over to the ledger here and I look to accounts receivable, I see 5208 right up here. Okay. And when I look down here, there's my 5208 in computer services revenue. And every time you make an entry over here, you'll make an entry over there. Okay. So wages, expense, and cash 875. It's exactly the same thing as we did before. Now, Let me pop back over here someplace and let me show you something because I don't want to miss this. Somewhere or another, we hired this person. Here we go. The company hired Lynn Addy as a part-time assistant. And they put that in there, but it's all that is an indication that they hired somebody. They didn't pay anybody. There's no economic event that happened here yet. The economic event happened down someplace down here toward the end when we actually paid her wages. Before that, there was no economic event. I mean, what would you record? There's nothing to record there. Okay. Now, there are a couple of others of these things that they threw in there, and I'm trying to remember where they are. I think it's down in the next section here. In one case, what they did, somebody didn't pay all of their bills, so they rebilled them. They didn't actually do anything. They just sent them out a copy of the statement. And so nothing, there was no transaction that was made when they did that. Okay. All right. So there's Lynn Addy's paycheck, wages, expense debit, cash credit. And now the owner comes in, he's SRA, and he takes out $3,600, which I'm guessing that's his paycheck. Okay. But anytime the owner takes money or any property out of the business, it reduces equity. That's why it's on the debit side here. And in this case, he took out cash, and the cash was paid out. So that was a credit. All right, so that took care of October stuff. And now we get into doing basically the same kind of thing again in November. The first thing that happened was we paid S. Ray, we paid him some mileage expense. I think it was 1,000 miles at 32 cents a mile. And so it doesn't come out of withdrawals because he didn't really take anything out of the business. He just incurred a normal expense that the business is now reimbursing him for. So it's not like he took cash out and said, okay, I just want to drive around. I mean, this was expense toward the business. So debit 320 and credit cash of 320. The next thing that happened was we did some more computer service revenue. And here's where you have to kind of be careful. In this case, we got paid immediately. So it's cash, not accounts receivable. And of course, the computer services revenue, that stays the same, but the cash is what is the change. And there it is right there. Okay. And if I come down here, notice that I handled this side of it exactly the same. Nothing changed on the right-hand side of computer services revenue. Okay, computer supplies and cash. So what we did is we went down to the store and we bought some more computer supplies. Paid $1,125 for them, and we paid it in cash. So if I come back over to the ledger and I find computer supplies up here, there's your $1,125. I paid it in cash, so you should find an entry over here, and we do, for $1,125. Accounts receivable computer service revenue. Same thing again, except this time we didn't get the cash up front. What we got was a promise to be paid later. So that's accounts receivable, $56.68, and computer services revenue. That part doesn't change. That stays the same whether we get the cash or we don't. So in this case here, we have 5668 into accounts receivable, making it go up. And over here, we have 5668 into computer services revenue, making it go up. The next thing that happened, we got $2,208 owed to us on accounts receivable, and it was just a partial payment. And so let me show you up here, see if we can find that thing right quick for you. Here it is, 5208. This is when we sold it, okay? Now, when they paid it, they didn't pay it all. They only paid it partially. So all they paid was 2208, so they still owe us 3,000. And this is what I was talking about before. They're not gonna cancel that $3,000 invoice that's still out there. All they're gonna do is send him a copy of it and say, hey, you still owe $3,000. So that's one of those things where there's no real entry that gets done. The entry's already been made. Okay, so we're gonna debit the cash here. So cash will go up and accounts receivable will go down. And if we looked at his individual account, we'd see that he still owes us $3,000. Now we incurred some miscellaneous expenses, and I don't remember what they were for, but we didn't want to classify them any other way. So we debit the miscellaneous expense, find it over here for 250, and of course we're going to pay that one in cash and find the 250 right here. The next thing, did another thing again. So we sold some more services. And so if you notice, if you look at those accounts receivable and computer service revenue entries, they're all the same. They just changed by the amount. Everything else is all the same. So we debited $39.50 to accounts receivable. Accounts receivable goes up, and we credited computer services revenue, and that goes up as well. So if I come back over here, you see the accounts receivable is right here. Okay, it's making it go up. And down here, there's your $39.50, making this number go up as well. Okay, we're getting toward the end. This mileage expense, same thing happened. Here he did, I think, 1,200 miles, turned in 1,200 miles of mileage expense at 32 cents a mile. They wrote him a check for $384 and charged the mileage expense. It didn't really go to him directly. He's just being reimbursed for his mileage. Now we have Lynn Addy again. This is our secretary, and she's been paid $1,750. And so wages expense, we're going to do it the same exact way that we did the other one up here for $875. The only thing that's going to change is that it's now $1,750. So if you look over here at wages now, we've got two entries, and the total wages that have been paid to Lynn are $26.25. And of course, that is an accumulation of all of the wage expense that you incurred. Now, the next thing is SRA withdrawals, the same thing again. This time he didn't take out 3,600, he only took out 2,000. And so, you know, the owner can make a decision about how much money he wants to withdraw, if any. In this case, he took out $2,000, and his cash out was $2,000. So if we look over here, we'll see here's the withdrawal, and up here, there's the cash. And every one of these entries, if you were to look over here, all you'll find is that every one of these entries from here has an entry over here. If it's a left side balance over here, this 1125 and computer supplies, well, there it is over here on the left-hand side. And we paid cash for it, so you've got to find 1125 over here on the right-hand side. Okay, and that's what you would do with every single one of these. All right, and so this should help you at least understand how these things are being recorded. And as I say, it's a video, so you can stop it at any point in time and replay something you didn't understand. Hopefully, I was coherent all the way through the thing. And the last thing they ask us to do, this was the first thing, and the ledger, this was the second thing, and then lastly, here's the third thing, the trial balance. Now, trial balance, all you're going to do is pick up the balances from each one of those accounts in the ledger. So if I look at this one, there's not a real number in there. It just says ledger D23. So I just said equal, and then I pointed to this number right here. Okay, and I did that for each one of them. I pointed to that number, I pointed to that number, and so forth when I got ready to do this. And when all was said and done, I've got all of these entries here on the left-hand side. I have all of the entries here on the right-hand side. So now let's add them up. So I'm just going to do a quick auto sum here. And notice that with Excel, if you have any kind of non-contiguous space, it'll stop at that non-contiguous space. So here I got to come up and just pick it all up. I'm just holding my left mouse button down, dragging it through that entire range. And then I'm going to do the same thing over here, except I'm just going to copy the formula. And note it comes to 98,659. And up here we have cash of 38,264. And if I go back over to the thing and look down here at the bottom, it tells us the November cash balance is 38,264, which it is on the ledger and it is on the trial balance. And the trial balance total 98,659. So if I go back up here, there's your 98,659. Here's your 38,264. Does it mean that we're correct? Well, not necessarily, but it does mean that our cash is correct. And it does mean that we're correct in terms of total balance. I could have, for example, I could have switched these two things around and put the 20,000 for office equipment and 8,000 for computer equipment. If I did that, I'd be wrong, but I'd still be in balance down here. So that should give you, and again, I know I went through it very quickly, but we're already at 25 minutes, and I really don't like to do these videos in much in excess of 30 minutes or so, because I know that you'll wind up shutting it off and walking away from it. So um, just try to stay with it for the 25 minutes, and everything should be pretty self-explanatory. If you have to go over some area again, feel free. If you don't understand something that I've done, feel free to give me a call. In the meantime, have a good day.